Hi, you're watching the special weekend edition of Business Plus right here on News 9 Live. I'm Karthik Malhotra. Joining me in the studio, my senior colleague Rakesh Khar.
Hi, Karthik.
Over the next 40 minutes or so, we'll take you through some of the most important stories from the world of business and economy that you need to close your week with. Here's what we have on the lineup on the show today. Security Exchange Board of India crackdown on finfluencers, Baap of charts barred from security markets, slapped with a 17 crore rupee demand in escrow account. Government's flip-flop on hardware import restrictions, change of heart or realization of impossible deadlines. US prints a 4.9% GDP growth as Eurozone slips closer to recession. And Infosys founder Narayana Murthy wants you to work more, much more, 70 hours a week. Will India's youth agree? Let's get straight into all these stories right here with Rakesh Khar. First up, SEBI has barred finfluencer Mohammed Naziruddin Ansari and 6 more associates of his that operate under the handle of Baap of charts. Ansari is not registered as an investment advisor, but offers stock market courses and investment tips through social media platforms like YouTube, X and Telegram. Additionally, SEBI has also asked Baap of charts to deposit 17 crore rupees in an escrow account until the scrutiny of the finfluencer is through. Is SEBI walking the talk, or is this the first of many such crackdowns waiting in the wings? Rakesh Khar, thank you so much for joining us on this weekend edition of Business Plus. SEBI crackdown on finfluencers, SEBI walking the talk. Many more such crackdowns in the offing right now?
I mean, something better than late, than never. This action has happened. I'm sure that it's going to set a precedent for many more who are in this zone to, to correct the course of action. But I believe that, it's a huge catchment area. SEBI has demonstrated its intent to go after them. But I don't think SEBI is yet completely seized of the problem or the canvas that is at hand. Because in the social media domain, Karthik, it's a very, very complex problem to begin with. Let's get deeper into it. First of all, greed is at the core of, an Indian investor. And even if you're not an investor, if you're shown up something that, that promises growth, which is realistic or not realistic, the guy who's looking at it from the growth parameter doesn't get into logic. He goes into emotion. He says that, well, it sounds very exciting, so he goes for it. And then, SEBI, all this while, when the era of influencers really happened over the last 1 decade, I would say, more so post-COVID, when people started watching more and more of content on the social media, did not really wake up to the challenge. And second very important component to is that Google is very happily calling us the YouTube nation. And this entire Googleization of content comes without any attendant risks and challenges. So anybody, there's no entry barrier. Anyone can start up a YouTube channel, similarly a Telegram service, and do whatever you want to do. So SEBI has been by and large sleeping so far. I'm unfortunately, constrained to say so. It's woken up right. Second, social media, very happy with the numbers. It keeps growing every day, and very happy to celebrate India as the destination to be, but not bringing any checks and balances, and greed at the context of it. And it's not for the first time that mis-selling is happening in India. So in that sense, welcome, but I believe that there is need for a concerted and a considered action across verticals who are involved in this entire finfluencer game. We in media are also responsible. We've been celebrating finfluencers in our own right. And I don't have an ideological quarrel with any of them going to business using social media as a vehicle. But the qualification, that's the other key parameter.
So, Rakesh, I have a fundamental disagreement here. While I understand that this is hard-earned money being invested in markets, markets by virtue are risky, everybody knows that. And there have been lack of educational options for investors like us. And you've seen much more of the markets than I have. We haven't really seen social media inundated with content from real registered investment advisors. Now the point is, at one level, you could have the social media open to a plethora of registered investment advisors who may or may not be relevant to the youth of the country, and their sort of communication skills and their advertising skills may not be the best in the world, but their brain is obviously in the right place because of the experience and education they have. My fundamental quarrel is influencers of all kinds don't necessarily need to be qualified. And if you leave finfluencers aside right now, look at travel influencers, look at food influencers. At the end of the day, you're spending your money on somebody who's advertising under the garb of being an influencer and you're still investing your money. So a travel experience, hey, go to Europe, go to so-and-so location in Spain, eat such and such food. You're listening to an influencer and you're spending money.
So
in this case, you're still using your money, but investing that money in stock markets and not in experiences.
Fair enough. I think the difference between an influencer and a finfluencer has to be very nuanced. And here it's a question about your hard-earned money. There it's about an experience.
An experience you buy with hard-earned money.
No, I know, but hard-earned money, there is, your experience, your tour experience will go bad, but up to a certain extent, here your entire money can get evaporated. So I think, there is.
So what should be the fine line? Is it fair to say that as an experienced, maybe not educated, qualified, certified investment advisor, but as an experienced investment advisor stroke influencer, unregistered, I understand, should you be at least allowed to give basics of stock markets, technicalities of stock markets, a macro view on how markets move, education on what is a large cap, what is a small cap, what is a mid cap, which direction historically has moved, which index? Is it fair to at least give that information?
Absolutely.
And not stock picking?
Yeah, so I'm completely in agreement with you. There is absolutely great room for education. Now, who has to do that education? If an influencer is doing it, it is at a cost. He has to invest into that platform. He has to host classrooms, virtual classrooms. He has to bring in further domain expertise. I'm saying RBI, SEBI, all other stakeholders should have invested in this particular ecosystem on their own. If you look at SEBI's traditional spending in advertising on investor communication or investor education, it's essentially in the print media. Unfortunately, no youngster who is looking at investing in stocks today is not reading the print media. So there is a wrong or a misdirected trajectory of the spending that is happening from the government side or the official ecosystem in educating investors.
Okay.
Those who are doing it, I'm happy they're doing it. You're right, they need to be qualified, but the remit has to be, so to say, limited, or needs to have a term and reference. It cannot be about straight away going into saying that you invest 100 rupees with me and then you will get 10,000 rupees over a period of time. That is quarrelsome, that is troublesome, right. And it has been allowed to happen all this while. And I want to take you back into a little bit of history. Mis-selling is happening right at the top. ULIPs. ULIPs. Absolutely. I bought a ULIP. Yeah. You bought a ULIP. Yeah. Nobody told us that there is a 40% cutoff right at there's a shave off right Absolutely. At the top.
Absolutely.
And it took us about 10 years to realize that ULIPs is a scam in that sense.
I lost ULIP. I lost money in ULIP. I wanted to withdraw my money because it wasn't giving me the assured returns, and a registered product bought through a bank or an advisory of a bank. I had to withdraw for an exigency after 3 years, and I lost almost 80% of what I had invested over those 3 years.
So let's clear the haze. Finfluencers who are educated are doing the right job.
Okay, let me try and take some names, or if not names, let me just try and use some attributes. A CA, a popular chartered accountant that uses CA in her handle, perhaps not a registered investment advisor, but has seen enough ups and downs of markets, understands enough ups and downs of markets. As long as she is not telling you which stock to buy or which index to buy or which mutual fund to buy, but is just giving you education to mull over. Education, not literal formal education, experience sharing. Should that be allowed?
That should be allowed. See, ultimately domain knowledge is what an end consumer is looking at. The way the sectors are changing. I mean, 10 years or 20 years ago, ExxonMobil was the undisputed leader as, in the entire market cap, return on investment. The entire pack is changing. It is moved to IT. Within IT, it is changing face again. So every 10 years, there is a new leader in the business. That is why business cycle is very important. So if someone has that experience, he would be worthwhile to share it with the end consumer. But stop short of pointing out a particular stock.
Okay.
Because however knowledgeable you may be about that stock, the person who is relying on you without actually looking at whether you're qualified or not is not actually empowered to take that decision.
Sure. Let's say Warren Buffett, celebrated investor, celebrated fundamental watcher, gets bullish on 2 stocks in India, 1 stock listed in India. Warren Buffett is not a SEBI registered investment advisor, does a video, compels people or prods people, or people get influenced to buy that stock outside of SEBI's remit. My fundamental question being, how do we prevent people outside the shores of India to act as finfluencers willingly or unwillingly, wittingly or unwittingly?
So Warren Buffett, yes. Because there is an established body of work which has
not
been...
a registered SEBI investment advisor.
We live in a borderless world in that sense, so we can't prevent Warren Body's body of work or knowledge, which is well established, from coming to Indian shores and Indian consumers. Nobody should do that. But within the ecosystem, both at the social media level and at the regulatory level and at the government's official level, we need checks and balances.
So, I just want to throw, jog your memory back.
So I don't want to just bash SEBI and, so I think, I want to take you back to early days of television.
Yeah.
I came from traditional business journalism, and we would not put out a story where there is not a quote from that particular company. Okay. Whether it is on their results or there is, early days of guidance, I can tell you. Yeah. Infosys started doing guidance in early 90s, I guess. And you would need a company person who is responsible for the domain. Right. Say the finance head or the, logistics head. Now, when television started with all its pieces, I'm a part of that journey, you are a part of that journey, started bringing in outside guys. Yeah. And over the last 2 decades, they have become like big ticket domain experts without necessarily having knowledge of that company. Right. And believe me, 99% of the times, nobody speaks to company. They speak to people tracking those companies. Right. And analysts. Who are these gentlemen? They are analysts.
Analysts,
so
researchers,
this huge,
data
big
crunchers.
Community of analysts, even with the qualification, have become an invested stakeholder or invested party in this case when it comes to determining the trajectory of a particular sector.
Sure. I want to jog your memory to something that Madhvipuri Butch, in her much acclaimed, famed meeting with registered investment advisors about 3 weeks ago. And a few very important statements she said, and many of them are coming on our screen right now as we speak. I think there was a question asked by Harsh Rungta, celebrated investment advisor. And Mr. Harsh Rungta, senior Harsh Rungta, asked her a question that if your guidelines are so stringent on everybody who's dealing with an end customer who's investing in the markets directly or indirectly, needs to be a CFP, needs to be a registered SEBI advisor, how do companies staff those people? These examinations are not easy to clear. They require enormous amount of studying. And if an individual invests so much time and effort and money in becoming a qualified investment advisor, he or she might as well start her own firm. So how do organizations which are meant to offer investment advice to end investors staff their organizations? At some point, is there a need for SEBI to even relook at the constitution of investment advisors and grade them as per what level of advice, what size of AUM for an investor are they handling? Because I think one size fits all approach may not work.
I couldn't agree more with you. There is, without being discriminatory, you look at the Skill Development Council of India. It started in 2014. They really farmed out skills customized for each particular unit. It's like auto components. Within auto components, there is a separate skill set for two-wheelers. Right. There is a separate skill set for four-wheelers. Right. And if I draw from the analogy of an IITian and an ITI guy, right. I'm not being biased, but both bring a certain skill set on the table. So I think in the investment advisory space, SEBI and all other stakeholders, including social media giants, should look at creating these courses, where you are equipped and trained and there is a certification which is good enough to at least arm someone who wants to share knowledge. Absolutely. There can't be a penalty on sharing knowledge.
Absolutely. So I think in this case, it is not yet a penalty, but this deposit by Baap of charts, 17 crore rupees of deposit demanded to go into an escrow account. An escrow account, if I understand right, is an account which will be jointly held by SEBI and Baap of charts. You will need both of them to sign off to withdraw money from that account.
Absolutely.
This 17 crore rupees being deposited in an escrow account, it's a huge sum of money. I don't know how much Baap of charts would have made over its lifetime.
I don't know how they arrived at that figure. It's a large piece.
I'm sure they must have done
But there would be some bureaucratic intervention there. See, what happens is that if you get the signal from the top that now we want to act, no one from the below in the bureaucracy, unfortunately, nudges the top that there is this grey area, why don't we act?
Right.
Or even if they say the top doesn't act.
Right.
Now that the top has acted, it's an overreach to my mind.
Exactly my point. I mean, 17 crore rupees is a huge sum of money. The penalty or the sort of forthcoming penalty, to my mind, could have been a much softer blow, because at some level, this is going to make the entire influencer community, not just Finfluencer, the entire influencer community, which is also being slapped day in, day out by ASCII guidelines on what is an advertisement, what are the disclaimers you need to carry, what are the hashtags you need to carry, is going to serve as a real detriment to people who want to go out there, make a living off social media. And I feel that if this 17 crore rupees Baap of charts is one among many waiting in the wings to happen, we are really talking about a huge market out there which will be cash strapped. How do they make their living?
Yeah, fair enough, but a correction has to be made. A correction has to be made.
So is this a precedent? Is this a warning for all other influencers out there that, hey, if you don't shut shop, if you don't go and clear your exams and splash your SEBI registered number on your screens, and if you don't tell us how much you are making from which stock.
See, there's a difference between an ASCII and a SEBI. SEBI is the watchdog which can actually enforce.
ASCII just gives you guidelines.
So that's the problem with the other. That's where it started. Influencers in the traditional domain became big. They driven corporate leverages, and the consumer suffered in certain cases and benefited in certain cases as well. So I hope and pray that it's a direction. Making one test case, and it does not follow, and there's no vindictiveness in terms of taking this entire positivity out from this area, which has its own shades of grey.
Absolutely. So I think the low-hanging fruit is not the only fruit SEBI should go after. Maybe pluck one low-hanging fruit to set an example of what that tree could eventually give you in terms of fruit.
Redirect its communication to areas where people are consuming that content.
Absolutely right. So let's move on, Rakesh. I think a lot to discuss on this, and we can carry on, but in the interest of our viewer, let's move on from SEBI's crackdown to government's kabhi haan kabhi na moment. So in August this year, the government shocked sellers of IT hardware like laptops, PCs, tablets, etc. by announcing import restrictions and licenses. It then softened its stand and said that this is not exactly a license, Raj, but just ensuring that hardware imported should come only from trusted partners. Government didn't qualify what trusted partners are. And government said that it just needs to be in the know of what is being imported into India, from where, in how much quantity. In parallel, there was a short deadline that the government started for hardware PLI applications, which got opened and received about 40 entries just in the nick of time for companies who want to manufacture manufacture IT hardware in India and avail of that very lucrative subsidy scheme of the government. In between all this, the government also pushed the deadline on import restrictions just once to 1st of November. Now, to the relief of some, the government has cancelled this restrictive imports altogether. Is this really policy flip-flop, Rakesh, or did the government really set very impossible deadlines to meet and realize that, it's not wise to reintroduce license, Raj, it's not right to be restrictive. And even if you want to get there, we've got to be more reasonable with our timelines.
Absolutely, but you have to see it in context, Karthik, what is happening all around the world in the global economy space. Free markets is now, end of the world. I mean, there is the passage for free markets globally is over. So each country, this happened in COVID with the vaccine apartheid. Increasingly countries are looking inwards. They make tall claims about, globalization, but when it comes to their interests, they're quite pronounced about it. I do remember early 90s, America was, the most developed economy, pushed for its companies like Boeing. I was covering aviation then, and it was a blatant pitch. And doing it in Indian soil, asking for orders to be placed with the government, Air India and Indian Airlines that time. So this free market syndrome is under attack because of one way, the emergence of right-wing governments across the world. Second, also economy being under pressure. So people are looking inwards. Government of India started this Atmanirbhar project, and it has its set of ridicule, it has its sets of accolades, but it's an idea which needs to be examined, and it's work in progress. So in that context, this particular piece was absolutely avoidable. So journalistically, we can call it a flip and flop, but any government which is looking at challenges on the security front, on the economic sovereignty front, has to address those challenges. We have gone after China manifestly in attacking some of those companies here, though the trade with China has increasingly been on the rise. So should we tackle that right away along with the border challenge? That's something that we have to look at. Coming specifically to this particular problem, I for one believe that we should not move a micron away from liberalization. I mean, the moment we call a licensed Raj, India is doing great disservice to itself.
Absolutely. It takes you back to 1991.
I go back to 1991 speech of Dr. Manmohan Singh, then finance minister. He said, we are opening our doors and windows, akin to what Mahatma Gandhi said. And he did say that, now 91 and we are at 2023. He did make a claim and promises that we will be a developed or a developing economy. We may not have reached there, but let's not undermine the fruits of liberalization. Let's not undermine the fruits of privatization that Vajpayee did, being a coalition government.
Right.
So there's a lot of learning. Mr. Modi is seen to be a strong, leader. It doesn't mean that, such actions need to be taken. I'm happy they've withdrawn. But there are three key messages. Why was it done? To promote local manufacturing. So if it is linked,
but were we ready for it? Were we ready for local manufacturing?
We were not ready for it, and there is a Chinese threat. Now, if you put a blanket ban, you not only, you are may or may not be able to kill the Chinese threat, but you are antagonizing the whole set of other manufacturers, including US, which is which you are building as a trusted ally in every particular aspect, and they are reciprocating that. So how do you bring a blanket ban and create an imagery that you're going back to license?
To the government, it never, called it a blanket ban.
Yeah.
And in many of its own defenses,
no, when you use the word security threat, so the premise was security threat. The second was promoting local manufacturing.
Right.
These were the two key pillars.
Of course, and trusted partners, import from trusted partners. So I think the government in its own defense had come out multiple times stating very clearly that we just need to be in the know. We just want to make sure that the brands which are being imported are coming from trusted partners. I don't know, by trusted partners they meant trusted countries, or they meant trusted laptop making brands,
so
vendors,
they have an origin
etc.
in a country.
Right.
Now look at one is the sentiment, the template. The other one is the business impact. See, we are a consumption driven story when the whole world is facing consumption stress.
Yeah.
So if the business cycle is in the growth phase, however small, you are putting a stamp on it. You are not allowing it to grow. I mean, laptops, desktops, these are essentials for today's Indian growth story.
Absolutely.
Whether you're a student, you're a professional, you're a doctor, you need it. You need to, use business as a business tool.
So tell me something, Rakesh. I don't know, I don't want to jump the gun and sound, slanderous on the government, but do you think this was at some level when the government would have thought about this policy, given statements, initiated the policy back in August this year? Do you think this was some sort of a way that the government was trying to arm twist manufacturers to set up shop in India? Was this arm twisting more done in the garb of preventing Chinese goods to flow into India? And there could have been many other tools to deploy that. So at one level, arm twisting, getting manufacturing to come into India, and at another level, for the PLI report card to show more green marks than red marks.
To look healthier.
Yeah.
No, see, as I keep saying, as a student of watching bureaucracy and political, that connection, the cusp, I think what happens is that this overreach happens on both sides. There is a political intent. The political intent in this case is very clear. We want to go after anyone who is threatening India's security, either on the border or on the economic front.
Right.
But if the guy who is executing that, the order, the tone, the tenor, the articulation, there is an overreach at times.
So I feel, Rakesh,
my sense, I don't have information independently, is that this was a bureaucratic overreach.
Absolutely. I couldn't agree more. I just feel that for any sort of manufacturing to happen or any new industry to come into India or any country for that matter, the approach has to be organic. The partner has to see value in what you bring to the table. We've seen the success of smartphones. Smartphones, the technology is honestly not very different from tablets. They're just bigger screens. They work on the same circuitry, the same communication tools, similar apps servicing both. However, in the case of laptops, we don't even have the fabs which go into the semiconductors which power up the motherboard of computers of all kinds. PC
embedded laptops and PCs is a grave security challenge.
I agree, but then so are smartphones.
I know, but smartphones, now the Chinese market share has come down significantly.
I agree. I'm saying, restricting Chinese imports and being brave enough to mention that we are imposing import restrictions from a country called China has a great political message in any case built in.
No, it's a difficult area, Karthik. It's a difficult area. Again, I mean, I am a votary of...
We did it with Chinese apps.
We did it with apps, but apps, don't have that much of a messaging. We haven't done it with the overall trade piece. We still, continue to import, which are relevant to us.
We are going on record saying we don't want to, settle Russian oil trade using Chinese yuan. We've gone and banned multiple Chinese apps. If I remember, 60 in the first tranche, 40 plus in the second, more than 100 Chinese apps.
I would still call that a minimal piece. It's a minimalist approach in terms of sending the messages.
And in any case, manufacturing is moving from China to India. The China plus one.
Early days.
But we've seen that in smartphones already. I mean, the government could have just waited for the organic
I'm not standing
approach.
for government, but I feel that, they understood that this has sent a larger external shock. I don't think they won too much by the domestic, backlash. They're more worried about external imagery. Mr. Modi is very keen to emerge as someone, and he's already emerged as a global statesman. In that sense, I think global businesses coming and saying that, oh, what is this? Please tell us, whispering.
Could it have been pressure from the US?
It is.
Biden was due to discuss this with Modi when he was here for G20.
If you are, I mentioned that and I articulated that if you are causing up to America and they're causing up to you every 24/7, how can you bring in this blanket security even if you don't state it upfront?
Absolutely. Right. So let's move on, Rakesh. Again, I think a story we can go on and on. But since we are talking Biden, since we are talking Modi, since we are talking US, I think let's move to the US economy, should we? The US economy has printed an impressive 4.9% growth in the September quarter, beating expectations of most economists. Growth coming on the back of higher consumption and just days ahead of the FOMC meeting starting Tuesday, where a pause in the rate hike cycle is expected. US bond yields also coming in at a two-decade high of 5%, with fears of a looming stock market bloodbath now more possible than ever before. Across the Atlantic, let's move to Europe. Eurozone is slipping. No more rate hikes, says ECB Commissioner Christine Lagarde. And a two-front war in Europe, Russia, Ukraine, and the Middle East continues to put pressure on oil. Are we looking at an uncoupled sort of a global growth GDP map, Rakesh? US growing 4.9%, impressive growth numbers, even though interest rates are high, 8% or so for retail interest rates. And on the other side, Europe, equally developed, great history of businesses doing well, slipping. We've seen Germany slip. We've seen France slip, and now the entire Eurozone, a pack of 20 large economies dependent on the euro, likely to go under in coming few months. Is this a decoupled sort of a world map that we are looking at now?
No, I think, the pointers are grave and grim. Let's not, anyway dilute them. But a little bit of a context is important here. It's not going back in history, it's going back to January 2023.
Right.
You remember we started there with saying that India and China are going to drive the growth,
Absolutely.
while as US and the entire European piece.
US was supposed to be in recession already,
so in that sense,
3 months back, honestly.
And both US and China are both shown better than improved growth. The Reuters
China numbers made in China, coming from China, I don't know how much we should.
There isn't much difference. The Reuters independent poll, however, I don't know, I don't trust their access. But whatever it is, it said 4.4, it is 4.9. So it's a decimal point difference.
Right.
So in that sense, January 2023 and then the war, Ukraine one continuing and the fresh war, in that sense, these episodic growths cannot be missed. They're unmissable.
Right.
But there's a very interesting paper done recently, I think about a week ago, by the World Bank chief economist, who happens to be an Indian gentleman called Indermit Gill.
Yes.
I don't know whether you must have seen that.
Yeah.
So he has presented quite a bleak scenario. And I think one would be, keen to buy that perspective. I don't think he's being negative, but he's being realistic. So a couple of pointers. So any growth in the global economy is linked to trade and FDI.
Right.
These are two very, very big pointers.
Right.
So there has been a decadal slump in trade. Now the future production, even if it was about 4% in the era of 2000s, it is going to be less than 2% for the next 10 years.
Right.
So that's extremely dismal. Now, the other big challenge is it's linked to FDI. FDI in India has fallen. India was like one bright spot, but FDI, because you don't know where you want to go.
Right.
It's not because of uncertain policies in India, it's because of an uncertain global environment. It's because of US's own challenges, which you very well articulated. So FDI, trade is under pressure. The third big pillar he points out, which I and you have been discussing several times, is public debt. Public debt globally is at a phenomenal high.
Right.
India's own debt is 83% of GDP.
True.
And now if you add the fiscal deficit, which is again, it's an elephant in the room, it may not be seen like that big, but it's a challenge. India has done well, to by and large keep it under control, but you never know when it will come out of the journey, especially with elections happening, this freebie politics. The combined, fiscal deficit of states and center is again at an alarmingly high level. So fourth, which is the most important thing, is the private investment. If there was one element which was driving growth despite these, so to say, headwinds, was private investment. Globally, all that is coming down. Now, what is the response? The response is a country like Indonesia, which is also seen as an emerging bloc, raised interest rates to 6%, I think, last week, October 14th, when their inflation is at 2.3%.
Right.
So why are they doing it? They're trying to hedge against potential backlash, political backlash if inflation raises its ugly head.
Right.
Inflation is a global problem, with one exception, which is uglier, which is China,
right,
where you're, looking at the other piece. And coinciding with this, Karthik, is the other negative piece is, slump in consumption globally. There has been an uptick in the US economy,
right,
but again, it's episodic. I think, the choice of what you're spending in Europe and US led and is in contrast to what is happening in the emerging bloc.
What can US do right now, both at the monetary policy level or at the fiscal policy level, to spur up that consumption? Simply put, the days of free money are definitely over. You could get a home loan, an education loan in the US for as little as a few decimal point percentage. I mean, it was practically free money. Today, you've got interest rates at 8%. Where is consumption going to come from? And interest rate cannot be cut down because inflation continues to be a worry. And 2% is the target of US Fed. It comes in at about 2.4% for the September quarter, not very away from the threshold of 2% that it has set for itself. But high inflation, and the CPI inflation, not retail inflation, headline inflation is much higher. So a 2.4% CPI inflation in the US, even a rate pause will keep benchmark rates in the range of about 5.25, 5.5%. Now, interest rates are going to be high. Where is US going to spur up this consumption?
Difficult. I mean, I don't have a solution, but I think, it's a challenge not just in US. I mean, Japan, for instance, with the lowest interest rates traditionally, has not been able to fuel consumption.
Right.
The one way of looking at it from a distance, I don't have data, is that there is a certain saturation in consumption there.
Right.
Whereas in India, there is a underlying, pent-up demand, which we are seeing.
Of course.
And that demand has its own contours. Like we keep saying that, we want to jump small cars, we want to jump small watches, we want to jump small houses, move into the bigger one.
True.
And so that aspiration level, even in US, from a consumption point of view,
Yeah.
despite much higher per capita income, has a certain saturation.
Right.
And with interest rates, everyone wants to, just hold on. So that hold on sentiment will get aggravated to my mind. And I want to be a little cautious here. India is in a relatively better place, but we cannot guarantee that that we'll be in that happy zone forever. With elections coming, and you've seen what is happening. 500 rupees gas cylinder, which in the marketplace with subsidies costing 1100 or 900 rupees. So a whole lot of this freebie putting additional pressure on the system is going to cause problems, and there are independent writers who are talking about this middle income trap.
Yeah.
It's going to be very difficult to get out of it. Moving from a $100 per capita income to a $1,000 per capita income is relatively easy, as has the experience shown. Sure. But moving from $1,000 to $10,000 in the given situations, in a depressed environment, is going to be a thunderous problem.
Absolutely.
That's where India has a challenge.
It's a weekend, I don't want to sound too somber and too dark with, whoever is watching our show. But I think one important implication on India, unmissable in fact, is the fact that US bond yields are also at 5%, a two-decadal high. 23 years ago, we've seen rates reaching 5%, yield reaching 5%. Now, obviously, FPIs, FIIs, money, bulk of money coming into even Indian stock markets is going to move to US bonds. Safe haven, assured return, 5%, 10-year yields. I mean, there are big numbers and assured sort of, risk-free investment. Now, obviously, this is going to have an impact on Indian markets in addition to US markets, because money is going to flow out from everywhere. But the worry is that this sort of yield is also going to put further pressure on discretionary spending by US companies. In an high interest rate cycle, US companies will find cost of capital to be exorbitantly high, may not want to expand, may not want to make too many investments. And India's already tepid sort of IT sector, which has been slated to look at a washout year ahead, could just run into that washout much quicker than expected. And hence, overall, bad news for India's growth, bad news for the Modi government in election year as well.
Yeah, bad news for export. I mean, there's a lag effect.
Of course, exports.
Yeah,
I mean, you have
exports, because the entire growth...
Imports, because it's going to put pressure on the Indian rupee.
Yeah, I mean, exports and imports are linked. That's where the trade comes into play. We had, by and large, been able to keep our CAD under check. but that's going to go for a toss. Your internal domestic, fiscal deficit is going for a toss. Your capex is not firing the way it should happen, and there is a limitation to government spending. In Indian case, the government spending has, so to say, done the heavy lifting, but for how long? Once the government, whichever wins, comes back, they will have a, coffer which may not be looking very bright.
Right, absolutely. Okay, coffer not looking very bright, but let's hope that some positivity, some silver lining emerges from these dark clouds engulfing all of the world, especially the West. India, thus far insulated. Let's hope we continue to stay insulated to as much a degree as possible. Let's move on and end this bulletin with something that Infosys founder Narayana Murthy said on a podcast. And he said that the youth of India should work for 70 hours a week, 70 hours a week to truly participate in nation building. 70 hours is actually even higher than what Murthy had said in a statement in 2020 during the start of the COVID-19 pandemic, where he asked employees to work 60 hours a week for the next 2-3 years. Well, those 2-3 years have come to an end, but Mr. Murthy's expectation has gone up by 10 hours a week. Rakesh, you put in much more than 70 hours a week. I think I can say that on record.
Nice of you.
I try to put in maybe about 60 hours, but youngsters working with us on our team, median age of India's population is 28, slam bang in the middle of what is referred to as Gen Z or the Zoomers.
Absolutely.
So Zoomers are not going to put in 70 hours a week. I mean, I think Infosys employees today would be saying, thank God Mr. Murthy is not CEO of Infosys anymore.
That's a nice one too. See, Mr. Murthy is adding a decade to himself, or every year he grows. I think he's going to increase the number of working hours.
It's directly linked to his age. He's 77, so put in 70 hours.
On a serious note, I think he's making a very important point. I think, there's a socio-economic perspective to it. There's a business, what we call a capitalist perspective. One way of looking at it is, as someone has pointed on Twitter, I'm borrowing it from there, that, these guys, he's fundamentally a capitalist.
Correct.
And a capitalist is looking at greater return on his investment. He wants to fatten his P&L, and he's getting his workforce to do more and more work.
Right.
But, if you take it back to say what, Lal Bahadur Shastri, did with the Indian, polity, the Indian electorate, he said, you sacrifice one meal a day, and that is the requirement of the hour.
Absolutely.
So to fuel the India growth story, to which Mr. Murthy is wedded to, I guess, to which all of us are wedded to, our network is wedded to, we believe that there is need to actually cross the barrier, set a new bar for ourselves. Especially when we do know that, with due respect to these youngsters who are brighter than me, more technologically advanced, more sincere, but not as hardworking. With no respect to you, there's a certain element of laxity, if I can use that phrase correctly or incorrectly. There is we are.
It's weekend. You don't need to be politically correct.
So all those who are products of shortages economy are driven by that sense of discomforture or insecurity.
Right.
Insecurity leads to security in this
Mr.
case.
Murthy in
Mr.
this
Murthy
podcast,
himself, now look at this, I mean, he is, 77, you're saying, and he is doing this podcast. At this age, he's learning a new medium, and he's not doing it for free. He's doing it to push his venture capital company, which is not necessarily doing that well. It's called Cataraman.
Right.
So, and who has he brought in as the first guest?
Mohandas Pai.
Mohandas Pai. So thereby hangs the table.
In fact, it's held on the platform owned by Mohandas Pai's son, Siddharth Pai, 314 Ventures. So I think it's a great sort of family coming together and
so they're pushing their capitalist agenda also.
Of course. So,
but there's a great social message.
So about 18, 19 years ago, when I happened to interview Mr. Murthy for the first time, and we done a series on another channel that I worked for at that time, I think my opening statement of the script was that Mr. Murthy is a capitalist at heart, a capitalist in mind, but a socialist at heart. So I remember that one line, but I want to come back to this podcast specifically. And
I'll give you an anecdote which is very, very relevant here. I got him as a guest for the budget in 1998 when I used to work at Z. He had come to our studios in the film city. And now how television is, that, we also got a little late on the shoot. So we got a little delayed, and we were not very good with technology. Then television was shaping up, and this was just huge set and everything else. And Mr. Murthy, he was absolutely 5 minutes ahead of his time. So his work integrity is impeccable. And, he almost walked off, and I had to request, and he was kind enough to stay back. So he's leading by example.
Absolutely. So I just want to go back to the podcast. And I think the example that Mr. Murthy sort of equated India and India's youth with was that of post-World War II Germany and Japan, which both had to rebuild themselves pretty much from scratch. today's youth is going to go back and question Mr. Murthy, if not directly, at least on social media, that we don't need any rebuilding. We are the 5th largest economy of the world, slated to be the 3rd largest, by turn of the decade, and of course the 2nd largest economy in all of Asia. We don't need to work that hard. We are going to get there anyway. Our numbers are shoring up. And I think a conflict that today's youth would have, which partly I could also echo, I'm a father of a 8-year-old child, that at some point you do require work-life balance. Work-life balance versus greed work, greed, selfish greed or greed for national growth. Both need to find some sort of a balance at some point. 70 hours a week may be great for a short stretch of time. You don't want your population burning out. The median age, like I said, 28. You don't want them burning out at 40. You want them to continue working and continue working healthily, even at a time when our demographic dividend may 20 years, 30 years from now turn into a demographic liability.
See, Mr. Murthy, at the heart of it is, making he's a thought leader. So he's leaving a thought for all of us to debate. I don't think he believes that it's the best solution, but it's a solution possibly which needs to be examined in its integrity. I think that there is merit in one particular generation, today's 20 plus onwards, to work harder, because all this 3rd largest economy, 5th largest economy, it's a number at the end of it. Our per capita income, I'm very happy about the way we are growing. We are all very happy.
We are growing on the back of others not growing as fast. It's not that we are going to be competing with China or US even 20 years from now.
And the larger goal that Dr. Manmohan Singh outlined in his 1991 budget, led by the then Prime Minister who had the political vision to execute it, Mr. P.V. Narasimha Rao, was that we want an equitable growth. That is not yet happening. I mean, we have some fresh additions in the Hurun list, which are like new age stories, but it is by and large dominated by certain big set of industrialists. So wealth, this bottoms up growth, if it has to happen, someone has to do the heavy lifting.
Someone has to do the heavy lifting. Coming the message not just from Narayana Murthy, but even my colleague Rakesh Kar here, and really telling all you youngsters out there, all unpopular, I guess, but all you youngsters watching this show, message coming from 2 stalwarts, one from the IT sector, one of course from the media sector and business and economy, Mr. Rakesh Kar.
Karthik is being too kind.
Pull up your socks, roll up your sleeves, get into that work culture and put in, if not 70 hours, maybe 60 hours.
For some time at least.
For some time at least. See your company through, see your country through, see your own aspirations through, and see us again next weekend when we join you here on the weekend edition of Business Plus. Thank you very much for watching.